Welcome to the Chaim Investment Advisors podcast. I'm Chaim, and I'm here with Pablo, Lasha.
That's right. We're here to talk about what are we talking about today?
Today, we're talking about earnings recession.
Those are big words.
Earnings
What
recession.
I'm gonna need more context. I think like a good way to get some context is what we should talk about. So we did a podcast about inflation. It's like recently posted, and before inflation, we were actually talking about the coming recession, right? Because part of the job is to be talking about things that are coming, but no one was asking about us about the recession because like no one knew about it yet, right?
Right.
People are hinting at it some places and they're acting like, hey, it could come. But it's like, well, it's one of those things. Like you can just follow the domino effect, right? And so when we first started talking about it, I think just my superficial understanding, right, is I'm like, oh yeah, they're gonna have to raise interest rates. This inflation is like out of control. At 8.5%, you have to raise interest rates, and you have to raise them significantly higher than like is politically. Well, some people would seem viable, but I mean, like it is what it is. Like you're gonna have to raise
At
them.
least convenient.
Yes. No, it's no one wants to, no one wants to raise interest. You have to raise them quite a bit. I think when I talked to you, I was like, I think if next year during the summer we were seeing like somewhere between 4 and 6% interest rates, I think that like we would be on target, right? And then like you would ask people and they'd be like, "That's insane," and I'm like, "That's just the beginning of what I think should happen." So a lot of different opinions out there,
Yeah.
but then we know that a lot of people in Wall Street and the investment markets like they could see this coming also. They're like, oh, we know how this goes. We don't want to see this happen.
Right.
And so that really affected the market negatively. They were not taking that news well from the Fed, which I mean I was, because I think this is the Fed doing their job, which I think is good. But nonetheless, like people were not taking it well, and there was we saw a bit of selling based on these like quote unquote negative news. I mean, in my opinion, the negative news would be continued inflation, past 10%. That'd be much more negative to me.
Right.
But so we saw that, right? But that's not exactly what we're talking about today, right?
It's not what we're talking about today.
Right, yeah. So I want to can you explain what we're talking about today? That'd be great.
Today, we're talking about, so the easiest way to think about this is, we had even done a podcast. I just reminded myself that we even did this podcast, was a year ago. We were talking about inflation and stock prices, and the fact that inflation is bad for stocks. And we said that a year ago, and people said, no, 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 and they went up higher, but we were right. And I hate to do that, but it's true. But the market when the stock market started coming down in November of last year, it was the very beginnings of it, through December last year, so 2021, December to now. There had been a lot of selling based on expectations of what would happen in the broader economy. So it was what we call a macro driven sell off, where people were saying, look, we're freaked out about what might happen. And with what we think might happen, we need to adjust our pricing models for assets. The price you pay for a stock like Facebook, or a stock like Zillow, or a stock like DocuSign is totally different if the interest rate is 0% or if it's 3%,
So
or if it's 5%.
This is the first phase, right? So this is the phase
one. We've been in phase one.
That's right. And this is a phase that I think everyone who listens to this podcast is probably like, yeah, I get that. You know what I'm saying? Interest rates are going to go up. We know that if interest rates are going to go up, then you're going to have a different profile of returns that you're looking for. You're going to have a different idea of like what you think makes sense to invest in. So this we understand, right? And so I'm on the same page. I'm with you.
Yes, and I'm actually going to try to put this on the screen actually for this podcast. Basically, we price that in according to most analysts' expectation, and what I'll put up there and what I'll reference now is that Bloomberg aggregates analyst expectations of prices, and they say, well, what's the really good case? What's an okay case? What's a recession case? And this is what I'm talking about right now.
Right.
And what is a really bad case? Really, really bad case. So a depression type case. And we got to the level that the consensus analysts said is the price that a recession would be for the market, for the S&P 500. We reached that price level.
So everything's going good.
And same with Dow Jones, same with NASDAQ. We pretty much hit the target. And market stopped going down for a few days there. Some of you may have noticed it actually kind of chilled out. And so today we're really talking about phase two, which is, so if we had macro driven, now we have fundamentals driven. And fundamentals just means the numbers that actually did happen.
All right. So, yeah, hit me. What's you're saying that even given the recession case scenario, things performed more poorly than expected.
Right.
And now we have a repricing based on fundamentals. Is that what you're saying?
Yes. And because the recession case was that basically we go into a technical recession of sorts where we had a bad quarter with GDP last quarter, and we might have kind of a bad quarter this quarter in terms of GDP growth, and then it would be declared a recession, but things would recover. And the expectations actually have been that by the end of the year, the market will be up on the year. I don't know about that at this point, but to that point, very few companies had actually lost money, or very few companies had actually started to really falter in terms of revenue, in terms of earnings, and inflation hadn't actually showed up on a whole lot of income statements in a way that was troubling. And it has recently started to, for the first time. There have been kind of the first signs with Walmart, with Target, with Cisco last week, that companies actually might be, the fundamentals might not be good. And when fundamentals are not good, the whole reason that this matters, if fundamentals are bad, usually across the whole market, so there's what we call an earnings recession, which is earnings recession is when companies are losing money, not when the GDP is in a recession, but when companies are in recessions. They do happen. It can be different from national recession. But usually what they got to do in that situation is pump money into the economy. They got to make it really cheap for people to be able to borrow. And that's exactly what they cannot do.
That's how we got here. And in fact, that's a very poignant point, because not only is that how we got here, that is specifically how we got to this place, right? Yeah. Because I think, as we discussed in an earlier podcast, for those of you who may not have listened to those podcasts or may not be familiar with the term of Fed puts, right? And so what we had was a situation where essentially when you went to like Wall Street or to investors or to the market, they had already calculated in that the Fed was going to put not like, I was just like, okay, that's going to be, it's going to be a bit of a pun there. But the Fed was basically going to prop up the markets. The reason they call them Fed puts is because puts are options, which basically, that's going to allow someone to sell something at some price, right? And so then it's basically some way for you to hedge against losses. So the Fed have been doing this so much, buying up so much assets, that there's this thing called Fed puts. Now, technically the Fed didn't call it Fed puts, but everyone else did. So that, literally
everybody did.
Yeah.
Including pretty major.
The Fed probably said it even behind closed doors, because that's essentially what it was. And so you're asking, how did we get to this place? You're like, Chaim, how did we get to this place where now we have this earnings recession? Well, the truth is, right, I think you and I agree, that fundamentally, they weren't making those earnings to begin with. The problem we have here is that because of these Fed puts and because of propping up the assets, we're now forced to have either some sort of transition where we all have this sort of, I don't know if we can all do it on aggregate, just all decide that something that clearly didn't happen. You know what I'm saying? And it's almost like, when you're a currency, if you're just you're having to rebase your currency or something, you're just we know that happened, but we're changing everything now because it doesn't make any sense. Which is
Right, we're
honestly,
lopping a zero
yeah,
off.
yeah, exactly, yeah. That's a terrible idea, by the way. But just saying, like in terms of like solution, that's not one we want to go towards. But that's like one of the options. So yeah, options that we just fess up and say like, hey, we had great markets for a while because the Fed propped up the markets, and they're in earnings session now because we all have to come back to the fundamentals. And as fundamental investors, that is preferable. In fact, as fundamental investors, like I think any fundamental investor you talk to, you often think like not only is it like is it necessary, but it's like intrinsic to actually having good institutions and a good economy to invest in, right?
Right, and another interesting dimension to the earnings recession idea that I haven't heard that discussed that much yet, but I know that it's figuring into people's math. When people were talking about what had happened with Target, with Walmart, and talking about the current condition of the economy. So Powell, Chairman Powell's most recent comments from the Fed about expectations, it was, well, people are spending money still. But this is another thing I'm going to try to put on the screen for everybody, so everybody's kind of on the same page here about what this really looks like. Revolving consumer credit just hit an all-time high. And so an all-time high amount of money is hanging out on Americans' balance sheets in revolving credit, and that's credit cards. So the technical word for credit cards for the most part. And so what that probably means in reality is that people are spending now what they expect to spend later, knowing that later, since inflation is high, it will be more expensive. And so people are loading up on current expenses as much as possible, as much as they can afford, while things are still relatively cheaper. Thinking that later, it's just people are doing things like their Christmas shopping now, for people who do Christmas shopping, because it's just by the time it gets to the end of the year, it's actually going to be a lot more expensive, and so you get people loading up on consumption that actually might mean less consumption later. Not that it's just going to be this constant rate of that's probably not going to happen, is what most economists have said, not to be too optimistic about the momentum of spending here.
Yeah, that is also inflationary. And then, like you said, with the decrease in spending later, that's going to be deflationary. So it kind of like harps on a theme, which I think that like we see throughout macroeconomics, which is that it's very hard to manipulate macroeconomic environments without seriously exaggerating the effects of things you're already trying to change. We already can tell that like normally in this situation, we would like to be pumping cash into the economy to get like out of the earnings recession. But we know we can't do that because we know the fact is that like there should have been an earnings recession earlier and we just didn't take that hit. And I think that like, I think this like brings us great, like first phase, now we're in the second phase. It brings us to a great time for you to like give me and like listeners some insight into like the sell-offs that we saw recently and how they're like fundamentally different from the sell-offs that like we saw earlier.
Right, because before it was a lot of it was we were in the expectation phase of, well, expectations are this is going to translate to that. And people were selling based on that, and now we're in the fundamentals driven sell-offs are usually a lot more challenging, because it's harder for markets to dig out from, okay, well, it wasn't just an expectation that things would happen. It actually did.
And I guess like there's a question like, do we expect long term though that our earnings or future earnings from different assets are going to change? Or is this, do you think, just the time where people are like, look, I need liquidity. This is going to be a liquidity crisis soon as the economy contracts. I don't want to be stuck out in the cold with assets when I need cash.
Yeah, there is definitely some of that. There's definitely, especially among retail investors, who a lot of them are selling now that the market is down a lot, which is usually a terrible idea.
Yeah, not a good idea, right?
But it is definitely a thing that's happening. People are saying, that's it, I'm out. This is too painful, can't deal with it anymore. And now I'm worried about there being a recession. So I'm just going to hang on to my cash, and that's a very real thing that's happening. I've seen some of it personally. Um, I always think it's a pretty bad idea, but people do
Well, is
it.
it not true? Like, yeah, that's a good point. Just like to stop and mull that over for a second. So, people who can afford it, right? People who can afford to keep their money invested should keep their money invested. I see this a lot
Right.
when
Yeah.
people talk about, there are times, obviously, even during recession, when you need to reorganize your portfolio. You don't want to be in Gold's Gym as you notice that Gold's Gym is going out of business, right? You don't want to be the last person without a chair there. But like a lot of times, if you're like, you go back to like, early 2000s, you're looking at Amazon or other companies like that, you know what I'm saying? People would die to get prices that Amazon was at during the recession. So I think that people, like you say, like, and as we brought up before, with Peter Lynch, who was like one of the biggest fund managers in the world, really successful, people on average lost money, not because of his performance. He was great. They lost money because they would sell low and buy high, right?
Right.
So
Yes. And yeah, you have some of that will happen in markets with this, earnings driven phase of a sell off. But the good news for investors, kind of some conclusions here, is that this actually is the more exciting phase as an investor who has a long term focus, because it's here that you start to see, well, who has been sold off too much, who is still in good shape. uh, Prices start to get into the pretty oversold territory sometimes.
you're seeing
um,
discounts, is what you're saying.
yeah, you definitely start to see it in certain segments.
Yeah.
Consumer discretionary right now, that's probably the one that I tend to be looking at the most, where, in continental Europe, the whole sector is down almost 40%, which there's a number of companies in there that probably that doesn't apply to, and probably will do just fine. And yeah, there's probably a lot more opportunities that pop up during this kind of second phase, where um, people become a lot more pessimistic during an earnings driven sell off.
Yeah.
And you have a lot of traders who are offloading positions in some of these companies based on earnings, but that has nothing to do with you as an investor. A lot of the times, the trader's getting rid of something because they need to cycle into the next thing that's going to get them back to even, kind of like gambling type behavior. Whereas as an investor, even if a company has lost money in the last quarter, you're not looking at the last quarter. You're looking at what has this company done over a very long time frame. How do they manage money? There's plenty of companies out there that probably will see with negative uh, earnings growth over the next quarter or two, that in reality have enough money on hand to pay for sometimes more than a decade of liabilities.
And you know what? Like, I think you bring up a great point. I like to bring up, usually like don't talk about specific assets here, but I saw one because I thought about this because this is one of the things that first got me investing. I remember seeing Netflix back in like 2008,
Right.
2009, 2010, thinking like these prices like don't make a lot of sense. You know what I'm saying? Like seems like a great company, and I'm not like endorsing purchasing a Netflix or anything like that, but like we can go look at the last time it was at 200. So 186 right now. So last time it was like close to 200 was December 1st of 2017. So in order for your thesis to like, not you and I specifically, but anyone's
Right.
thesis to have changed that much, where it raised to like, which were probably, is a little overvalued, where it raised to like $700 sometime last year. But nonetheless, for your thesis to change from like sometime last year being at $700, today being $200, when you're talking about a company, again, when you talk about like in terms of liabilities, you're talking about a company that has like very good margins. You know what I'm saying? Like their
Right.
subscription base, they have a lot of potential to build. If you look at like the subscriptions that they lost, right? A lot of subscriptions they expected to lose were from the Ukraine-Russian war, right? Which isn't expected to go on forever. You know what I'm saying? Like these things are going to resolve themselves. So you have to look at like the fundamentals, like what's going to happen long term. And so I think, like you say, sometimes we have traders, they're hedging their positions, and then we have retail investors, and they're kind of like following suit, right? And it's not necessarily going to make sense to like
Right.
sell your Netflix stock if you thought that it was a good purchase, 3 years ago. It probably is even a better purchase today.
Right. No, and I've had people ask me like, "Chaim, are you selling things personally?" And the first time somebody asked me that recently, I was shocked. I was like, "No, no, I would never sell it just because something has gone down. As the thesis entirely changed, well, that's a different topic. Those do
Totally, totally.
I
Yeah,
haven't seen one of
right,
those yet personally.
right.
For me, it's always, oh well, this is where the really interesting buy opportunities start turning up,
It's
and
exactly right.
so
Yeah,
it actually starts to get interesting now during those big macro driven sell-offs. A lot of the times, it's actually hard to turn up real value because a lot of the times basically what's being sold is just the most speculative stuff. It's basically they're not cheap yet.
yeah.
There are plenty of companies that I saw go down a good 20, 30, 40% that still were not cheap in
Yeah,
my
yeah.
for cheap
Not
for my
well
purposes.
relative
um,
value, right? Like where's the best place to put your money? What's the great opportunity cost? And like thinking about the something of like a similar note, you know what I'm saying? Like I think like part of the problem definitely is that like we have people who are doing what's trading and it's not necessarily investing. And when we see those like macro trends, what we see are like people like not only institutions trading but like retail traders uh, making decisions that are based on short-term outlooks. It's not based on
right.
like the long-term outlook. Like if you have like Facebook, if you have Amazon, if you have like Netflix, your trade over a year is way different than like your compound interest or like your future earnings over like 10 years. You know what I'm saying? It makes like zero sense to look at it in that context.
And that's another really great point that had occurred to me with kind of this topic of like what made phase one and phase two a little bit different from each other. This first kind of macro driven phase of the sell off, a lot of the companies that were the most sold didn't have good fundamentals in the first place. People were not, to your point,
Well, they were overpriced, right?
right. People
Yeah.
weren't in those for long-term fundamental reasons. People were speculating on
Yeah.
they're going to make money someday, right? Uh, and then it didn't. And so, or they started to shift their expectations of like, well, now it doesn't make sense to take this kind of gamble on these companies making money someday, as we talked about last time, a rotation um, due to higher interest rates
Right.
that had been going on too, where people were not in these stocks because the fundamentals are fantastic, because they make money.
Right. There.
And that is different from
Yeah.
where you start to see Target and Walmart, go down 20, 25% in a day. Those are spookier, in the short term, not in the
Right.
long
In the
run.
short term, exactly. Yeah. And like that brings up a great point also that we discuss all the time, which is that like as investors and anyone who's like a serious investor, these are kind of the times that you wait for. I mean, you're obviously not like thrilled to like have an economy that's like in a recession or a bear market, and people are going to be hurting, and obviously like it's going to be tougher on some people than others. But as an investor who wants to like gain more value, these are the times where you see like quote unquote like bargain basement deals, right? I remember like when Brexit
Yeah.
happened, you had all of these like securities just like super super cheap, and the whole thesis wasn't really, it was all momentum, right? It was all just like, well,
Yeah.
things are changing. I don't know how they're changing. I better get rid of everything. And it's like that's not like that's you wouldn't do this with other assets, right? Like if I told you that like that for the rest of the month it was gonna rain or snow, you wouldn't suddenly be like, I better sell my car and and buy a new one, you're like, no, I bought my car knowing that the weather that was going to be stormy was going to come, and I'm prepared for that. And that's the same way I think that we should look at as investors in order to also just stay calm and ready for those deals. I know that you personally, we speak a lot, and like you personally, you're telling me like, there are these great times and opportunities to buy if you have like some money to invest, and you're waiting to like make those decisions for both yourself and for your clients and for everyone else. So.
Right. And the deals, they start to pop up more in stuff that's interesting. I think that's the interesting thing about a kind of more fundamentals driven phase of things, is the companies that usually people are in for the fundamentals, those start to be cheap, and that's when it starts to get really some good buys, because I guess to a certain extent, some of those tech stocks that are down 80-90%, they've never made money before. Like, they literally have never made any money. They're not profitable. They're cash flow negative. They have been for years and years and years. Nobody was ever in those because they made money. But then the stuff that where they do make money starts to be cheap. That is a more interesting in the long run, but also can feel worse in the short run, because a lot of things that are safer investments start to come under heat in a way that dividend stocks previous to the big sell-off last week had only been down about 6, 7, maybe 8% on the year at various points, compared to NASDAQ's 30 some percent. Whereas now that's starting to shift. They're starting to come closer. They're still not in bear market territory, but they're even starting to get closer to bear market territory. And that's, that is more distressing for a lot of more conservative or more fundamentals driven investors. But again, that's where some opportunities do start to pop up.
Yeah, that makes sense. And I think, like you said, it depends on what the primary goal of that asset is, right? I mean, if you're looking to receive a stream of income, it's going to matter a lot more if earnings are affected. But even in the case like where we have growth stocks, right? If you've purchased a growth stock and you're looking over that 15-year span, still probably not a good idea to sell it when it's low. I don't think that that's the solid plan.
Right. I think it's never really made a whole lot of sense to me why folks do it. But yeah, it's probably going to see a lot more of it starting about now, where people before there was just a ton of selling. That was a lot of institutional investors and hedge funds and traders, and they were just doing this whole macro trend trade. Yeah. And then you start in this phase to potentially see some people cash out of markets because they're under too much distress. You get the throwing in the towel phase, perhaps over the next quarter or so, if things continue, which is sad. As a financial planner, that is the part that is the most distressing to see socially, in terms of the damage done is then severe. But at the same time, for most people who talk to us, listen to us, you should definitely be thinking about, okay, well, the real take here is, where do I start looking for interesting stuff to buy? Totally.
I mean, like you said, it doesn't make a lot of sense to sell low and buy high, but it can make a lot of money for the person on the other side of that trade. And that's where the opportunity is. I think there was two things I was going to touch on, which one of them was like, just as a note, you and I talk a lot about like the investment world and things that go on. And like, we've talked about different fund managers, et cetera. And we noticed that, like, even like 2 years ago, but like more and more, like people would just say, that guy Warren Buffett, he's really fallen off, and like we're just sitting there being like, hey, he's holding a bunch of cash. It's probably for a reason, he's been around for a while. He probably knows what he's doing, And I think this is, now we see exactly why Mr. Buffett was holding a bunch of cash. Some of the more rock star investors, their performance is looking about the same with a lot more variance, a lot more risk. So basically getting the same performance with more risk is not what you and I would call great, right? We'd like to get the best performance with least amount of risk. As investors, that's always what you're aiming for. And so you're looking at some of those other rock star investors, and you're like, yeah, you did the same. I wasn't going to say it, but we're looking at the same performance, but the variance is much higher, and the risk has been much higher. And I think, nothing against Kathy Woods, but like I think that like people who sit around and talk about an investor, he's been an investor over 80 years, and done all right for himself. To say that the guy is like falling off because 1 or 2 years he wasn't doing what you thought he should be doing, I think that's kind of like hilarious to me. I think this is like as a side note, a little lighthearted humor there. It's kind of ridiculous. But the other thing I want to talk about, which is like something else that we also talked about. So we saw that like the Fed's 50 basis points, something like that. I don't remember. Like, to be honest, like it sometimes can be very dry to listen to them talk about what they're not going to do. And but they were like, oh, we'll try to raise it, and like they talk about 50 basis points, which is not like a lot, and not nearly where they need. They're not even talking about being on track to where they need to be. But the fact is, we all know as investors and people who study macroeconomics that like it's going to go higher. And this is what we've seen. That first phase is what we saw with just the 50 basis points raise. You know what I'm saying? So while I do think that long term things are going to not only be better, but they're going to be great, right? Like that's the general trend. If you look at like stock market and equities and other like asset classes, general trend is like upwards in America. Right? Like things have been doing great, but we should expect, like I think to some extent, there's going to be like higher interest rates. And I don't know if the market has really priced that in. So what do you think about that? Do you think that the market has realized that, like, because are we still in that like sort of delusional place where we go, oh no, this isn't real? Like,
right. I think, the bond market probably has been the most accurate at pricing in future rate hikes
right.
Because the bond market's much more sensitive to those things. And people were really freaked out earlier in this market sell-off we've been through, where bonds priced in a lot of rate hikes very fast because the thing to understand that a lot of people don't know about the bond market is the bond market doesn't wait for each rate hike to price in that rate hike.
Right.
When Powell says, we're going to do 7 rate hikes and 0.5%, or nobody has said that, but the expectation has been
right. I mean,
something like that.
This is like I think what we can all think of as the bare minimum. If you were going to say like, is this a group of people doing the bare minimum? The bare minimum is to get somewhere around 4%, if not higher. I mean,
right, 4%,
politically not convenient, but it's the
4% at this point is definitely priced in for bonds.
Yeah,
like
as it should be.
And they price that in very fast, and that's why each meeting that has had a hike has not actually been that bad for the bond market yet. But actually, bonds, it went up this last week, which is another good kind of a side point we probably don't have time to get to today of about the this kind of earnings recession. And how do you know that it was different? Well, bonds actually went up when stocks were going down, and
well, that's a key indicator. And in fact, the key indicator that you are entering into a recession in general, regardless of like the technical definition of how many quarters we have to have. If you see bonds beginning to like appreciate against stocks, that like that at least large amounts of capital believes that we're going into a recession, right? So,
right, and that was what happened last week, where bonds were actually. I started to notice it early in the week. Bonds were coming up on those days that stocks were under the most heat, and usually, that's a pretty good indicator. You're in a whole different ballpark in terms of what people's expectations are. But yeah, that's the bond market has priced in those rate hikes up to a certain threshold. Now, 5% is probably a little bit over what that threshold is, and something really wild like 6% is absolutely not at this point priced in.
It's not priced in.
No.
But I think
because it would need to be another, the whole Barclays aggregate bond index would need to be at least another 5-6 points lower
So,
for that to be the case.
like, I have a thesis. We'll see, like, what you think about my thesis. My thesis is that, obviously, as we talked about in the other inflationary episode, which you guys should listen to, but if you didn't, we discussed, like, a little bit of this inflation could be called transitory, right? A little bit of this inflation are just, like, certain events and certain things which are going to pass. I wouldn't say a lot of it, I wouldn't say more than 25% of the inflation, but let's say that, like, we have this amount of inflation and 25% of it is going to be transitory. And let's say that, like,
chart for that.
and then you should definitely bring up this chart. And then, like, let's say after that, we can ease in to 4 to 5%. And this is my thinking of what, if you're going to ask, like, what the Fed is thinking, because even though they're not supposed to be super political, the fact is, they're human beings. They don't want everyone mad at them. And people are going to be mad at them if they raise it to 6%, right? They'd like to not do that. So what they'd like to get away with is raising it to somewhere around 4%, maybe 4.5%, or something like that. Just very small increases. And they'd like to see, a little bit of easing off of sort of like the inflationary fiscal policies, right? Maybe like raising taxes, or maybe like cutting some spending. And then they'd like to see like some of those transitory things, and then see if they can get inflation under control. And I think that is their hope. Like, they're hoping that, like, next year that will happen. But if it doesn't happen, they're going to have to take more drastic measures. And then we see that in, like, the like late 70s, early 80s, the kind of drastic measures that you have to take if inflation gets to a place where it's above 10%, it's getting out of control. You have to take serious measures where you're going into like 16 and 17% interest rates. This is not to, like, scare anybody. We're just talking about, like, historical events.
Right, and I do wonder. I do seriously wonder if the current lineup at the Fed actually kind of has it in them to do it, because
you and me both.
The Reagan era Fed was unique. I mean, it was the most hawkish by far that it has ever been, and it had something to do with the personalities there. And even Powell himself has talked about, like, he's not Volcker. He's absolutely not. And
he doesn't have to tell anyone that, to be honest.
I know.
No one was confused. What is that? Wasn't it like a presidential debate with like Dan Goyer or something? And he was like, was it like, he's like, I knew John F. Kennedy Sr. or something like that. I don't remember what it was. It was like, what I'm talking about? Yeah, it was something like that. And he's like, you, sir, I know. Like, I don't know if it was like Kennedy or something. He's like, you, sir, I know. That was like really funny. So that's a similar situation. I think that you're right, but I do think that the situation, regardless of whether they're really ready to go there politically, I do think that, like, coming next summer, if you don't have inflation under control, I think that you're going to see serious changes. You're going to see there's just going to be the pressure to do it, and if those people don't do it, you will see people appoint people to do it, because you can't go on in a situation where you have, like, inflation that high. It's just like it's a situation that, like, rapidly gets out of control. And regardless, like, where anyone lies on the political spectrum, people who have a lot of wealth invested into America are not about to watch it, like, just disappear because things are politically inconvenient, right? So the bottom line is like that will, if they don't have it under control, like, coming out like next summer, like, and obviously I think everyone hopes they do, but if they don't, like, I don't think that you have a choice but to have, like, serious rate hikes. Of course.
And there have to inflation. So I think, a lot of people also have said, well, if the Fed is not going to live up, and if they're telegraphing, we don't have it in us to do it, then that actually means more radical fiscal policy. Like,
exactly.
There's every possibility you get a much more dramatic fiscal policy than is normal for us.
And I don't think that this Fed will go down as a very popular Fed, like, in history. I don't think that, like, those people who may not be aware, but, like, we've tried to be tasteful in our critique of the Fed, but this Fed is not, like, even close to what I would consider popular among investors. Just some of the policies that they've done, and some of, like, what they found to be the priority, and to be honest, some of the lack of discipline. I think a lot of it is just a lack of discipline. Like they said, they don't want to be the people to be the bad guy, and sometimes that's your job as a Fed. You have a job and you have to do it, just like anyone else. I think the other thing, like you said, is that, like, regardless, there will be serious fiscal policy changes.
Right.
The upside, I think that we can say, is that like this sort of earnings recession and the things we're seeing are also reactions to the Fed not really taking the appropriate steps that, like, so even though like investors and Wall Street often can be like, we don't want to see this happen, but it's often like when you're playing a basketball game, you're like, look, I want the ref to rule on my side, but he has to make it a fair game. You know what I'm saying? He can't just be out there just ruling against the other team all the time. It's a similar thing here. In order to like, have a strong institutions where like people can make money, and investors and Wall Street know this, that like they have to have a somewhat of a fair game, and it's not going to be fair if the Fed doesn't like rapidly get this under control. So the upside of taking this sort of hit is like we're eating a little bit of our medicine in the front. We're eating our veggies first, I guess. You know what I'm saying? It sucks, but it's much better to go through the summer till like next year, and like you have this 4.5% or 5% hikes, and then like that was it, and then you come out and then you're back to being golden, and like hopefully at that time other macroeconomic events are like under control, and we're not having to worry about supply shocks and people being inside their houses for long periods of time. And then that's a good situation that we're coming out. It's like relatively good, because as you and I know, like look back through like the economic history, these things can go a lot worse.
Oh yeah.
Even as much as we're not super big fans of this Fed, these things can go like much more terribly. And like I think that we are actually going to do a podcast on fiat currency and how great we've had it in America with fiat currency because of like strong institutions and because also some policy decisions, some of which I think suck, but some of them are good, as opposed to some other places where it has not gone well.
Right, because it's an important part of that conversation of we are people who refer to the effectiveness of fiat regime in America are quite privileged to note that, given it has not gone as well elsewhere, and it isn't going that well in a lot of the world right now, as we're talking
rather consistently, actually. And I think that like there are like two things we're not going to talk about now, but I just want to mention these like two things. So we're going to definitely have a podcast. Just exactly. There are two things America has going for it. One, we do have a great checks and balances system. We have a system which like appropriately divides fiscal policy from monetary policy, though I would argue some of the mandates that the Fed has now shouldn't be their mandates, and that's the reason we are where we are. But again, we'll talk about that in the podcast. And then like we just have had like a lot of economic prosperity, and to be honest, like prosperity helps everything. I don't know for those of you guys who ever play cards or poker, but when you're winning, everything's great. You're like, you couldn't be a worse poker player than when you're just hitting every high hand. So I think that there are a variety of factors, and Chaim has his own views also about like what are the great sides and what are the downsides, and how we've been lucky. And that's definitely a podcast we're going to do, because like we've been excited to talk about that for a while. So
excellent. Yeah, no, I'm excited to talk about that. And yeah, we've been coming up with all kinds of cool ideas, but I think that's a pretty good place to kind of wrap up talking about the earnings phase that we're in of the sell-off of, okay, we're in a little bit of a different zone now than we were. And it's important for people to know that and not have it in mind that we're still, riding this trend that had been going on, because, that might actually lead you to make bad choices.
That's true.
Because, if you think of it as one downward slide from that, well, I think there's some mistakes that can be made there, and probably some wrong decision making could come out of that kind of presumption. And our focus has just been, hey, let's now start really digging for the deals, and that's what we're focused on, not so much trying to take evasive maneuvers by selling things, which is not, no investment advisor really does that. I know it's just that the consensus view of research is that that's just usually the wrong thing to do.
Totally.
And still the case in this case, because in reality, in the longer run, things will get better. But yeah, Fed's got to tackle what it's got to tackle, and
gotta do something.
We also need a whole a lot of regulatory clarity coming out of the midterm. So that's like a phase 3 that everybody needs to already have in mind. We're in May.
Yes. Yes, that's right.
This year, pretty important midterm elections in terms of policy direction.
We're talking about tax hikes. We're talking about cutting spending, and we're talking probably about, like, regardless of who wins, some of a little bit of all of that, right?
Right, and that's what I mean about fiscal. The fiscal side there's every potential for it to be quite dramatic. Some major changes that are not Americans are not accustomed to
Yes.
on deck after midterms, kind of depending on the outcome. And you'll see a lot of traders positioning around that heading through the summer of it could stay choppy all the way through, according to some of the asset managers that I talk to are saying, there's people jockeying for fiscal shocks from fiscal policy. And so, that's phase 3. So,
it's gonna be a busy June, July, August, September. This was going to be one of the busier trading.
A hot summer.
Yeah, that's right. That's right. Yeah,
long hot summer in markets. Because usually we're already deep into when it usually people say, sell in May and go away. People are still here. So I think
nobody's left the table.
Right. That's where
but I think this is great, and like Chaim said, hey, we just do this podcast, do a quick one, because we want to talk about this issue because it's on everyone's minds, and so we're glad you guys took time to listen to it. We will be doing other longer podcasts, but we just want to talk about this issue specifically because everyone is concerned, and we wanted to just give a little insight about what really you need to be concerned about, and it's usually the longer vision because a lot of work is done in the financial planning side to make sure that these things are taken care of. So.
Right, and we plan for this kind of stuff to sometimes happen.
Exactly.
So, this is why we do it.
It's 100%.
Excellent. Well, Chaim Investment Advisors podcast. I'm Chaim, and
and I'm Pablo. Yeah. See you later.